Hey everybody, Richard Norris here, and in this video I want to share with you the difference between buying a property in a limited company versus buying property in your personal name. Now in this video I'm going to share with you what I've learned over the years, having been a property investor myself and currently a property investor as well. I'm building a multi-million pound property portfolio, what I've learned along the way. I'm going to share with you insights of what I've learned around buying properties in a limited company and a personal name. From having spoken with multiple tax specialists across the UK and multiple accountants about this situation, I'm going to share with you what I've learned. I'm going to share with you what's working for my clients. And we're really going to talk about, what is the difference? Because a lot of my clients, and I get a lot of people asking me, like, should I buy a property in my own name or should I buy a property in a limited company when I'm thinking about building a portfolio and based on their individual circumstances? So in this video, I really want to cover this question off and hopefully give you some insights, and hopefully it's going to help you in your own life to make the decision on what's right for you. So just a disclaimer before we go into the presentation. I'm not a qualified accountant, or a property tax specialist. Any information that I share with you in this video is from my own personal experience of what has worked for me and my clients. When implementing any of the information given in this training, you should always get financial advice from a qualified accountant or a tax specialist. Okay? So now the other thing I want to share with you is that as this is a very specific area of property, it is extremely difficult to cover every person's unique circumstance. Therefore, the information that I'm sharing with you at times will be at a high level, but it will be very helpful for you to then to apply to your individual circumstances with your own accountant and property tax specialist. So it's just really important to note today that when I go through this video with you and I teach you about these different things and share my insights, that you apply it to your own situation and you don't listen to my advice about what's right for you. This is just a general overview of the subject area. And again, you should always speak to your own tax specialists and accountants when making these sorts of financial decisions for yourself. So with that out of the way, let's jump into what we're going to cover in today's training. So we're going to look at the different variables that you need to think about when faced with this decision. I'm going to take you through the exact questions that I ask myself when I'm faced with, do I buy a property in a limited company or do I buy a property in my personal name? And if I'm building a property portfolio, do I buy the properties in a limited company or my personal name? And then we're going to take a look at something called Section 24 buy-to-let tax changes, because these tax changes that came in August 2020 really changed things for a lot of people. Now, if you're an existing investor watching this video, you'll know from experience that if you owned properties in your own name before 2020, that it was a good thing to do. But since the tax changes, the buy-to-let Section 24 tax changes came into full fruition, it had a big negative impact for landlords that own property in their own name, and therefore potentially buying in a limited company from a high level seemed to be the right thing to do. So I'm going to share with you some calculations. We're going to do some calculations together through the presentation that's going to help you to understand what Section 24 is and actually show you the granular impact that it has on a numerical level. Because one thing that I want to share with you is that every decision that I make when I'm growing my portfolio is just based on the numbers and the data. So I'm always looking at the analytical data to make my decisions. I'm never generalizing or being kind of high level. I'm really looking at the granular data when I'm making my own decisions and letting the numbers dictate which way I go. And based on the variables of growing a property portfolio and what I want to achieve. So I'm going to share some insights with you about how I do that. Then I'm going to go through the advantages of setting up limited companies to buy properties, the disadvantages of setting up a limited company to buy properties, and I'm also going to share with you naturally as we go throughout the presentation the advantages and disadvantages as well of buying a property or buying properties in your personal name, so that we can really make a fair assessment and have like a weighted discussion about which one is right for your personal individual circumstances, because you're going to see that there's not really a right or wrong answer to this, but there's lots of variables to consider. Because I think that a lot of people at times, like, they create this dichotomy that there's one right or one wrong, and it's either limited company or personal name, but it's never really that simple when we boil it down to the granular and we look at everybody's personal individual situation and assess their own personal tax merits. Now, then the final thing to wrap up the presentation, I'll kind of conclude, I'll give you a summary, and we'll go through the net result of the discussion about which one I'm more favored or leaning towards and why. And I'll also give you my own personal opinion on what I do and how I do it. So with that being said, what are the variables that you need to consider? And I want to share with you today the variables that I consider. So these are the exact questions that I look at when I'm building my portfolio. And naturally, from me speaking about what I do, naturally we'll come into the conversation maybe about like what you could do as well and what might work for you. So whenever I'm faced with this question, do I buy a property in my own name, or do I buy a property in a limited company, or for the matter, properties? I always look at like, what is my personal tax position at the start? And I basically say to myself, okay, in my situation, am I a lower or higher rate taxpayer? Now, if you're a 20% taxpayer, you're a lower rate taxpayer. If you're a high rate taxpayer, you're a 40% taxpayer. So those are that's the first thing I look at, because really that's the number one thing that starts off the decision-making process. And then I start to look at like, what are the goals that I have? What am I actually looking to achieve by building a property portfolio? And like, is it to build intergenerational wealth and create a legacy for myself and my family? Is it to build a multi-million-pound property portfolio? Is it to just buy a few properties, 2 or 3 properties that I might buy in my own name to retire with, and I have no other sources of income at that point? Or am I looking to retire and have the properties as an income alongside any other forms of income? So I might be a 40% taxpayer in that situation. And my goal is to build a property portfolio for a retirement as a supplementary addition to that. For some people, it may be that they want to they want to build a property portfolio to replace their income from their job, and they're seeing property as a way to build a long-term wealth creation vehicle that's going to allow them to work on their goals and aspirations for life if they don't really like what they do, and they're kind of in that cycle of trading time for money, and that's not what they want to do. So those are like the considerations, like what are the goals for you, and that will determine like whether you go limited company route or whether you go personal route. Now, I always look at like, what is my own personal situation like when it comes to family life as well. And you should consider this as well, or could consider it as well. So like, I look at like, what is the most important thing for me? So again, just reiterating this here, but like, if I've got children, which I do, have 3 stepchildren, then like for me, building a property portfolio of intergenerational wealth and building a legacy is actually one of my drivers, one of my goals, and is a big part of my why. And therefore, inheritance tax and things like that for me are really, really important. And so like having something like a smart company, which we'll discuss as we go through the training today, is a really beneficial thing, right? Because if inheritance tax is important to you, like, then you may not want to buy properties in your own name, because there's quite a bit of an exposure to that. But we'll cover that off as we go through the training, and this is why this is important. And I think it's a big point that most people overlook. Like when they're starting a property portfolio, they don't really look at all of these considerations. They kind of make the decision on the merit of now, rather than the long-term thinking about what they actually want to achieve. And therefore, what they do now, as they grow the portfolio out, they become actually building themselves a tax liability, as opposed to building a wealth vehicle where it's kind of like a wealth, kind of like a, what's the word I'm looking for here? Basically, you're building a portfolio which saves taxes, right? So the other thing that you're going to consider is like, am I going to need the income from my portfolio? So a question I always ask myself is like, do I need the income? How much of the income do I need, and how much am I going to take per year? Like, what's my goal? Am I going to take £100,000 a year out of my property portfolio to pay myself? Or do I not need any income from the property portfolio at all? Or is it just going to be to cover my basic needs, which might be around 40k or 50k a year, right? These are the things that I'm considering. Now, if you're like me, my personal situation, I personally don't draw any income from my property portfolio. So it just becomes a self-fulfilling loop where I just keep reinvesting the money to gain compound interest. I have other vehicles in my life where I take my money from, and other forms of income. But if you're somebody who's watching the training and you're thinking, well, actually the property portfolio is going to become my main form of income, then that's again another consideration for answering this question. Then you want to look at like, what is your appetite to risk? So I sit down with myself and I say, okay, Rich, on this specific deal, what's your appetite for risk? What's the goal here? Like, is this a risky thing? Is it a not risky thing? Like, what do you want to achieve? So like, some people have the belief that, if they want to buy 2 or 3 properties and they have lower loan to values, less lending on their properties, that it's safer. As opposed to somebody who might want to, aggressively build their portfolio using a buy, refurbish, refinance strategy where they're leveraging up to the maximum amount of 75% each time. But really, the reality is, when you look at the data, between 75% and 20% doesn't actually determine how risky the portfolio is. It's not actually the lending that determines that, and the loan to value and how highly geared you are. It's a variable, but it's not the main thing. But that's for a conversation for another day. So I'll try and keep on track here. So the next thing is like looking at what property strategy or strategies are you going to be implementing? Because I think this gets missed out a lot as well. Like, when people are making this decision, they're not focused on the strategy or strategies of what they're trying to achieve. So it goes back to, again, like, they don't have a clear vision of their goals. And if they don't have a clear vision of their goals, then it's really difficult to do tax planning because you get it wrong. Like, the truth is, you get it wrong. You're only focused on the now. You think about what's right ahead of you, and you don't think about all the other variables and the opportunities that could arise from growing the property portfolio. And of course, like, at scale, when you start to scale things change. Like, what your situation today is won't be your situation tomorrow, in 5 years, in 10 years from now, right? So you really need to think about the considerations of what property strategy that you're going to be implementing. Because, like, if you're looking to do, like, for example, myself, I do the buy, refurbish, refinance strategy. I leverage to 75% a lot of the time to pull most of my cash out. I aggressively build my portfolio, and I do lots of the renovations through contractors and stuff, and that's how I grow my portfolio. I've got lots of single lets, I've got lots of HMOs. I convert the properties that are 3-bed properties into 5-bed HMOs, properties that are, say, 3 or 4-bed properties into 6-bed HMOs with en-suites, etc. And I do a lot of commercial to residential developments as well. So I take like office buildings and convert them into residential apartment blocks. So those are the strategies that I use, and they have an impact onto which way I go. And the truth is, like, there's a diversified strategy here as well, because another strategy that I implement is I buy in Oxford as well, where I live, and I buy for a high capital growth. So a long-term high capital growth strategy where I'm less concerned on cash flow and I'm more concerned on capital growth. Whereas when I invest in the Northwest and I'm implementing the buy, refurbish, refinance strategy, I'm really focused around looking for high yielding properties that are going to give me the highest return on investment possible. And those variables, when I'm talking about the different strategies that I use, affect my tax planning strategy as well, as to whether I buy them in my own name or whether I have a combination of buying in my own name and a company, or whether I just buy in a company, right? So the strategy is really important because, like, furnished holiday lets, like, we have lots of clients that do furnished holiday lets. I personally don't do them myself, but like a lot of clients that we have do furnished holiday lets. And I know from experience, and I've learned that having worked with these people, that basically furnished holiday lets don't get taxed in the same way that buy-to-let gets taxed. So, for example, where a buy-to-let residential property, if you have it in your own name and you're a higher rate taxpayer, Section 24 tax changes will have an impact. It doesn't when you have a furnished holiday let, like, it's exempt. So, like, sometimes furnished holiday lets can be a good thing to do in your own name, but equally, they're actually okay to do in a limited company as well. And again, it depends on your personal situation. But this is why the strategies, and I'm trying to give you some examples and analogies and real life applications where this has happened and come into fruition, so that you can understand how important the strategy is to the decision-making process. So let's start off with, like, what is Section 24? Now, the first thing I want to say, that if you're watching this video and you're a lower rate taxpayer, Section 24 does not apply to you right now. However, your position today won't be your position in the future. And hopefully, through my training and through my videos, that we can share insights that enable you to become a higher rate taxpayer. Because ultimately, right, if we can, in an ideal situation, everybody wants to be earning the most money that they can and that what they need to enjoy the life that they want to enjoy. Okay? So even if you're a 20% taxpayer, pay attention to this part, because this may affect you in the future. So Section 24 scenario 1. So the first scenario I want to talk to you about is that if you're buying properties in your personal name before Section 24 tax changes and you're a higher rate taxpayer, this is how you would calculate the returns. So I'm going to go through a tax calculation with you here. So we're buying one property in this scenario, and we're saying that we bought this property. It's a single let property, and the rent is £1,000. The mortgage, the interest only mortgage, is £400 a month, and therefore the gross profit is £600 a month. £1,000 minus the 400 gives you £600 of gross profit. In this scenario, in the worked examples that we're going to go through in this presentation today, I'm not making any allowance for things like monthly operating expenses, for voids, for buildings and contents insurance, and all of those things, because I really want to make this video and training and presentation, I really want to make sure that you can understand it and follow it. So I want to keep things as simple as I possibly can, because when you talk about taxing property, it's actually really specialist and you can go really deep with it, and it's quite complicated. So for the purpose of the video, I want to make it as simple as possible so that you can understand the mechanics behind your decision-making process. Now, therefore, in this example, the annual gross profit is £7,200 a year. 600 times 12 gives us £7,200 a year of our annual gross profit before taxes. Now, if you're a 40% taxpayer and you own property in your own name before Section 24 came into fruition in 2020, then you would pay 40% tax. So 7,200 times 40% is £2,880 in tax. Then the next thing is you got your net profit. So your net profit is your 7,200 times your 40% tax of 2,880. 7,200 minus the 2,880 gives you a net profit of 4,320. Okay, so that would be the scenario if you're in that situation. Now, that was all well and good, but then something called Section 24 came into fruition and things changed. And the government basically introduced this legislation, and this is the new tax calculation. So this is an example of buying properties in your personal name after Section 24 tax changes, and this is if you are a higher rate taxpayer again. So the rent's £1,000 again, the mortgage is £400, but Section 24 tax changes that came into fruition, they basically said that you were no longer allowed to offset finance costs against your rental income. So you could no longer offset your mortgage payments or your interest only mortgage payments and then pay the tax. You basically are paying tax on the full amount of the rent. You can't deduct the mortgage and finance costs. So in this scenario, the gross profit is £1,000, right? So the annual gross profit is 12,000. 1,000 times 12 gives you 12,000 gross profit a year. 40% tax on the 12,000 is £4,800, which gives you then basically what happens is on the £4,800, the government said that you get 20% tax relief on the interest-only mortgages. So we take 4,800, we times that by 20%, which gives you £960, 20% of the 4,800, and the government said that you can have that as a relief. So 4,800 minus £960 gives you your tax due of £3,840 in this scenario. Now, we have to allow for our expenses in this scenario. So we have our mortgage, and our mortgage payments are £4,800 a year, plus our tax, which is £3,840, which gives us a total bill at the end of the year in expenses plus tax of £8,640. So our net profit is our gross rental income of £12,000 a year, minus our expenses, including taxes and our mortgages, which gives us £8,640, which gives us a net profit of £3,360 in the same example as previously. Okay, so what this means is that actually in the previous example, our profit was £4,320, but now with the new changes and the new implementation of Section 24 buy-to-let tax changes, our new profit is actually £4,320 minus the £3,360, which gives us a lower profit, of £960 per annum. So in this scenario, we're making £960 less than in the previous scenario. So you can see why in this situation, when people were buying properties in their own name previously as a higher rate taxpayer, it was a good thing, and now it's not so much because we're losing money. So if we're thinking about long-term thinking, and this is the thing, right? Because even though that we have this difference of just £960 a year between the previous example and this example, when we're thinking about long-term thinking, £960 on short-term thinking a year doesn't seem like much of a saving. You're probably thinking, well, that's not a big difference. It's not like a game changer. But actually, when you think of long-term thinking and you take the £960 a year that you're losing because of the Section 24 buy-to-let tax changes because the increased taxes you're paying, that 960 times a period of 10 years means that over a 10-year period, actually, if you were to buy properties in your own name with Section 24, in the scenario, you're going to lose £9,600 over the 10 years. Now, if you had that scenario played out against 10 properties, then that's £96,000 that you've lost in 10 years in taxes. So again, like, this is the thing that I really want to encourage you to do, is like, I always think long term. When I'm investing is a long-term thing. It's not a short-term thing. But I do think a lot of the time people think that, like, they use property as a vehicle to, like, quickly replace their income, and they think that they can replace their income really quickly, and they really look at it from a short-term cash flow strategy. But actually, the way you get wealthy in property is you hold assets for the long term and you collect cash flow every month from that. But it's a long-term strategy. So the first thing is, like, I've noticed, like, people are often making their decisions on short-term thinking. And when you build a property portfolio, you really need to think about long-term strategic thinking and process delayed gratification over instant gratification. Because if I look at my decisions from a compound interest effect, from a compounding effect, which is how I like to think about my investments, I don't just think about the decision today. I look at the calculation today, and then I multiply that variable over a 10, 15, 20, 30, 40, even 50-year period, right? Because that's how long I'm going to be building my property portfolio for. Like, I've at least got hopefully another 60, 70 years left on the planet. So I need to be thinking long term if I'm thinking of holding my assets for that long, which is my goal. Okay. So this is how I really encourage you to think about those decisions, because you can see, like, if you just look at it from a short term, it doesn't seem that much. But then when you multiply it out and you multiply it out over a number of properties and you repeat that process, that's really where you lose a lot of tax. Let's take a look at a limited company structure. So that's buying properties in your own name, and the scenario between what you used to pay as a 40% taxpayer versus as to what you had to pay now if you owned properties and you were a high rate taxpayer, right? So let's take a look at a limited company scenario. So if you're buying properties in a limited company, and in this scenario, we're going to use the same example so we can make a like-for-like comparison. The rent is £1,000, the mortgage is £400, the gross profit is £600, and the annual gross profit again is £7,200. Now, in this scenario, though, we only have to pay corporation tax. If you're a higher rate taxpayer and you're not drawing this money as income, you're leaving it in the limited company, at the end of the year, the $7,200 accrues and you just pay the corporation tax at 19%. As of today, as of the recording of this video, corporation tax is at 19%. It may go up, it could go down, you never know. Obviously, the talks are all about going up, but who knows? Wishful thinking is that it could go down or it could go up as well. So as of today, corporation tax is 19%. So 7,200 times 19% is £1,368, right? So in this scenario, we just have a tax bill of £1,368, which means that our net profit in this scenario in the company, if we buy the property in the company, is £5,832 a year. Now, you'll see that that is a lot greater than if we're to buy the property in our own name as a higher rate taxpayer with current buy-to-let tax changes with Section 24 being in fruition and coming into play. So when we look at the net profit gain in this scenario of buying a property in a company versus buying the property in your own name, we basically have this gain. We have £5,832 of net profit by buying it in a company versus the profit that we made in the previous scenario where we were buying the property in our own name as a 40% taxpayer with Section 24 was only £3,360. So in this scenario, if we're to buy the property in a company versus buying it in our own name as a 40% taxpayer, we actually make an additional £2,472 per year, or you could say save £2,470 per year, £72 per year in taxes via a tax saving strategy, right? So if we look at this as long-term thinking, our extra gain, our extra £2,472 that we're making every year, if we times that by 10 years, we make another £24,720 over 10 years. But then if we apply that scenario and we apply that across a portfolio of, say, 10 properties, then if we're to buy those 10 properties in a limited company versus buying the 10 properties in our own name, just by buying them in, making the decision to buy all 10 in a limited company, we've just made an additional £247,200. So guys, we've just made an additional £250,000, right? So this is the effect of looking at numbers and looking at long-term decision making. Like when we look at the numbers on short term, it seems small. But when we look at the the significance of actually multiplying it out and building it as a long-term property portfolio, the picture changes completely, and it actually makes the decision a lot easier. So in this scenario, obviously, the right thing to do would be to buy in a limited company, right? And I agree, if we're just looking at those figures, that would seem like the logical, most beneficial way to buy the properties, but it's not so simple. And there are a number of variables that we need to consider, which is what I'm going to take a look at. But really, let's take a look at what are the advantages of a limited company to start with then. So some of the huge advantages of buying in a limited company are that you pay less tax, right? Now, with a limited company, what we can do is we can create a director's loan account. So any money that you put into a property limited company on the day of incorporation or over time, whether that be savings from earned income or money that you make from a business sale or money that you make from selling a property, or any money that comes into your life after taxes that you put into the property portfolio to buy the properties, so effectively the money that you use to put down as deposits, that money that you put into the incorporated business goes in as what we call a director's loan account. Now, that's hugely beneficial as a property investor, because if you create this director's loan account, let's say you put £100,000 into the business on the day of incorporation, and you use £100,000 to go and buy some properties, the £100,000 goes into those properties as a director's loan account, and then those properties give you cash flow. Now, that cash flow from those properties can be drawn into your personal name alongside any other income that you have in your life, and that income could be £10 million, for example, and the income from your property portfolio, because you're drawing it down as a director's loan account, can come into your personal name completely free of taxes. So it's a great tax saving strategy, and for me, that's actually the biggest advantage of setting up a limited company versus buying a property in your own name, because the moment that you buy a property in your own name, even if you're only buying 2 or 3 properties, that £100,000 that you use to buy 3 properties in your own name doesn't come with the director's loan account. So even if you buy those 3 properties and tie up that £100,000 as deposit, the income that's generated from those properties, so let's say it was £30,000 just as an example, that £30,000 would still be taxed at 20%. Right? Whereas if you did it in a limited company, the £30,000 in the same scenario can be drawn against your director's loan account, and that money comes into your life completely free of taxes, independent of any other income that you have in your life. So for me, that's a huge advantage of buying in a limited company versus buying in your own name, right? And the reason that you can pay less taxes as well in a limited company, if you're drawing the income down as a higher rate taxpayer, is if you're drawing the income from your property portfolio, you can do it in the form of dividends. Now, dividends are taxed at just 7.5% up to £50,000 after we've basically declared our basic rate of tax, our marginal rate of tax, which is roughly around £12,500 per year in the UK at the moment. We have that as a tax-free allowance. Anything from £12,500 to up to £50,000 is taxed at just 7.5% as a dividend, where again in your own name, any income above the £12,500 up to £50,000 would be taxed at 20%. So there's a saving there. And also, you can declare a dividend, and you can pay a dividend to yourself out of the property company, and up to £150,000, so between £50,000 and £150,000, on the dividend that you declare at that margin is taxed at 37.5%, okay? Whereas again, if you're a high rate taxpayer, it'd be taxed at 40%, okay? Now, the other important thing to note with a limited company is that you actually do also get a £2,000 dividend allowance, which is tax-free every year for each individual in the company. And if you had a company that had an alphabet share structure, then you'd be able to declare income to multiple individuals and use multiple individuals' marginal rate of tax to withdraw the dividend at the lower 7.5%, the marginal rate. And remember, every single person that draws income from that company via the alphabet share structure gets a £2,000 dividend allowance. Now, the alphabet share structure and smart company structures, which I'm going to talk about in a second, are covered in another training video of mine. There's a video on my channel called The Perfect Property Tax Strategy, and in there I talk about alphabet share structures and smart companies. So if you head over to that video after you've watched this video, it will go into an in-depth granular detail around that. But we're not going to cover that detail off in this video because it's going to get too complex, and I really just want to keep the main points in here for you to consider. Now, the other thing is that when you buy in a company, mortgage lenders often look at the stress test of a property as opposed to your personal income. Now, when you buy properties in a personal limited company, the current stress test is 145% at 5.5% interest rates. That's the variable that they use when they're looking at lending. So they say, okay, what is the rental income of this property? And then what is the mortgage payments against the property at 5.5%? And they want the rental income to be 145% bigger than the mortgage interest at 5.5%. So they're basically looking at more from a business profile as opposed to your personal affordability, okay? Which again is an advantage, right? Especially if you're somebody who earns less than £25,000 a year, having the money in a company, having the properties in a company where they're looking at the actual lending of the asset in the company as opposed to you affording the mortgage in your own name and therefore looking at your affordability makes it easier to actually get mortgages in a company in that example. And as you scale it out, it becomes a lot more apparent as well. Now, the other thing is, one of the other advantages of a limited company is that you get limited liability protection. And this is a little bit of a counterintuitive point, but effectively what this means is that when you buy properties in a limited company, it basically means that you don't own the company. So if I use in a scenario, in this example, I own all of my properties in a limited company. That basically means that in my personal name, Richard Norris does not own any property. Actually, the company that he owns, or the companies that he owns, because I have multiple SPVs with different properties, those companies own those assets, but the company is owned by Richard Norris himself, right? And this basically technically means that my buy-to-let limited companies, or my SPVs, are a separate legal entity to anything I do personally. However, this is actually a counterintuitive point in my opinion, because more often than not, 90% of the time, I still have to sign a personal guarantee, which basically links me personally to that mortgage, all the mortgages in the company, and I'm responsible for paying that debt if something would have happened to that property and it was, say, for example, for whatever reason, the loans were called in on my property portfolio. If the company could not afford to repay the loans, then Richard Norris is personally liable to pay those loans back, but under the personal guarantee that you sign. So it is a little bit of a counterintuitive point. Now, the other thing is, a huge advantage of a limited company is if you set up a smart company structure, you can mitigate all of your inheritance tax, and you can also benefit from other variables such as paying private school fees, education fees to your children completely tax-free in these sorts of scenarios. Or when I say completely tax-free, little to no taxes using people's marginal rates. But on the on the inheritance tax perspective, on the inheritance tax side and inheritance tax calculation, if you own property in your own name, typically speaking, if you don't do anything fancy, 9 times out of 10, whatever you own in your own name is building in your personal estate, and therefore anything above the threshold, the nil rate tax band for inheritance tax, anything above that is taxable at 40%. Now, personally, like myself, who has 3 stepchildren and other clients of mine that have families and have children as well, inheritance tax is actually a big consideration for us. So in that situation, in a normal limited company, by the way, inheritance tax is not covered. In a normal limited company, you're still going to pay inheritance tax. It's still building in your estate. But in a smart company, if you're to be a bit more astute about what you're doing with your tax affairs, and you were advised to set up a smart company, in that structure in the limited company and the alphabet share structure that we create, it mitigates your inheritance taxes. And again, I'm not going to talk about smart company structures in this specific training and presentation because it's going to get too complex. I have separate videos on smart company structures. Again, I refer to the perfect property tax strategy, and in there is all about smart company structure and how that can benefit you if you're an individual who has a family and has children and is thinking about bloodline and asset, kind of passing on assets later on as like an intergenerational wealth strategy. Then that's going to be important for you versus buying in your own personal name. Now, what are the disadvantages then of a limited company? Well, the main disadvantages of a limited company are that you pay higher interest rates on your mortgages. So in your personal name, currently today, as of today, interest rates in your personal name are around 2.5%, right, for buy-to-let mortgages. However, in In a company, you're paying around 3 to 3.5. So typically speaking, on single let buy-to-let properties, in this example, your interest rate on mortgages is roughly anywhere between 0.5 to 1.5% greater in a limited company versus buying in your own name. However, this does become less relevant when you're building out a portfolio and you have more than 4 properties. Because if you have 4 properties or more, even if you have properties in your own name, you are classed as a portfolio landlord by mortgage lenders, and therefore your interest rates become more in line with that of a limited company anyway. So in that scenario, if your intentions were to have more than 4 properties in your own name, then actually this disadvantage in the limited company actually becomes obsolete, because you're going to pay the same either way. But if you were building a property portfolio, or you just wanted to own a few rental properties in your own name, anywhere up to 4 properties in your own name, then you are going to benefit from paying slightly lower interest rates on your mortgages. Now, the second thing is, one of the biggest, another disadvantage of having a company is that a limited company is more expensive to run from an accounting perspective compared to a self-assessment tax return. So if you buy properties in your own name and at the end of the year your accountant submits your SA 302, which is your self-assessment tax return form, then you're going to pay less for that service than if your accountant's having to do all of your bookkeeping every month for your property company. You have an obligation to submit your accounts to HMRC. So at the end of the year, you have to do your tax returns for the business as well as your personal income tax. You're going to end up spending more by buying on your accounting fees by buying properties in a company. Now, the other thing is as well, one of the disadvantages of a limited company is you can only draw dividends if the company is making a profit. Now, this might sound crazy when you think about it, because you're thinking, well, obviously, if I'm going to build a property portfolio, my intention is to make a profit. Yes, but actually, a very smart tax planning strategy that property investors use, like myself, is if we use a buy, refurbish, refinance, repeat model, which hopefully a lot of the people watching this video will be familiar with, then you can offset a lot of your capital expenses. So a lot of your capital expenditure when you're building your portfolio, if you keep building it aggressively, and specifically in the early stages, if you're spending hundreds of £1,000s on refurbishments every single year and you keep using that model, you can actually end up having a very healthy net cash flow every month. So you might be making 10, 15, 20,000 pounds of net cash flow a month. But at the end of the financial year, the company, your property company, still shows a loss on the balance sheet because of the capital expenditure that went out. So this is this is actually a tax strategy that property investors use, like myself, to make sure that at the end of the year we actually don't even have a corporation tax bill as well, which is one way good. But in another way, if you need the money out of the company and you don't have a director's loan account, or you've utilized, so you would have a director's loan account, so it's the wrong terminology. The best language I should have used, is if you've used all of your director's loan account up and therefore you need to take a dividend, if the company hasn't made a profit, technically, even if you're net cash flowing 20,000 a month and you're doing well, but it's not showing as a profit on the balance sheet, you cannot declare dividends. So you cannot benefit from the lower rate of 7.5% on the dividend, and you won't be able to pay any other people. Even if you had an alphabet share structure, you wouldn't be able to distribute those profits by paying a dividend. You'd have to basically pay all of the people, including yourself, if you wanted to take the income. You'd have to be taxed as an employee of the company, and you'd be taxed under pay as you earn, PAYE. Okay, and that's a more expensive way of doing things, right? So generally speaking, in most cases though, there are less disadvantages of setting up a limited company than buying in your personal name, in my honest opinion. 9 times out of 10, in any given situation, if I am faced with buying a property in my personal name, even if I'm a lower rate taxpayer, I'm still probably going to lean towards buying in a company because of the director's loan account, which I'm going to go into a bit more detail and reiterate again, because it's such a big important consideration. In my opinion, when I look at things, depending on how large the director's loan account is as well, normally speaking, it makes sense to buy the properties in a company. However, sometimes a hybrid can work, and therefore, if we're talking about hybrid and diversified strategy, then obviously you get the benefits of both. But in my personal opinion, if I was faced with a decision to go with personal or limited company, I'd probably always lean more inclined to the limited company based on the factors that I've discussed throughout the presentation so far. Now, so therefore, limited company or personal name, I've kind of answered that question a little bit prematurely, but I'll kind of go into it a bit more detail now and give a bit more substance to what is the best option and the variables. Because what although I've been a little bit biased and basically kind of leaned towards a limited company based on my own personal situation, which obviously creates some bias, but also having worked with a number of clients and experienced their personal situation, when we typically do our accountants and our tax advisors that we work with, when they do their assessments, most of the time our clients are advised to buy in a limited company. However, there isn't a black and white answer, and it really does depend entirely on your personal situation. So for example, if you're purely intending to buy only 2 or 3 properties for retirement, and in retirement you won't have any other income in the future, then buying in your own name is an option. Because if you're going to be under £50,000 of a year in income from the property portfolio, you're going to be a 20% taxpayer. You don't have to worry about Section 24 tax changes, and you could buy properties in your own name, and you could also buy properties in your wife's name, or we won't talk about partnership. Let's keep it just simple for now. You could buy properties in your name and properties in your wife's name if you were a married couple, and you could both benefit from the tax allowances that way. However, even in that situation, purely for the fact of the director's loan account, I'm going to go towards a limited company. And the reason I'm going to go towards the limited company is because I benefit from the upside of the director's loan account withdrawal. So even if I had £100,000 and I bought 2 or 3 properties in my own name, I'm still paying 20% tax. Whereas if I bought them in the company, I'm saving all of that money against my director's loan account. Now, this situation that I'm talking about here assumes that you have no other losses previous in your life that you can carry forward and offset. This is purely on the basis that we don't have any other losses. We're purely just buying 3 properties from scratch, and we're buying them in our own name, or we're going to buy them in the company. In your own name, there are benefits that I've spoken about: lower interest rates on your mortgage, and all of those sorts of things. But in your own name, and just paying 20% tax. But if I'm faced with that decision of own name versus company, and I'm in that situation, in my personal opinion, I'm going to choose company, because I'm going to put the £100,000 into the company, and I'm not, even as a lower rate taxpayer at 20%, I'm going to save the 20% because I'm actually going to withdraw the income out of the company, paying nil taxes, but for the first few years based upon the director's loan account withdrawal that I've created within the company. Okay. Now, if you intend to build a long-term property portfolio, then a company is typically the preferred route. So if you're like me and you want to build a multi-million pound property portfolio, and you're going to be an investor for a number of years, and it's a long-term strategy, and you want to create wealth through property, then a company will typically be the most preferred route and will save you a lot in taxes, and also give you a lot of asset protection as well when you do joint ventures in the future and things like that. Okay, so if you're thinking of it from a business aspect, then a limited company usually is going to be the preferred route over buying in your own name. And the other reason is because in the limited company, of course, you can create that smart share structure and the alphabet share structure, which you can benefit from inheritance tax savings, and you can also benefit from distributing your wealth to all of the shareholders within the company and using other people's marginal rate of taxes, so you can bring the money out of the business in the most tax efficient way. Okay, now sometimes having a hybrid, so having some properties in your personal name and a company, can be an option. So when might that be an option? Just to give a hypothetical example, so let's say that you were looking to retire, or even let's say that you were looking to retire. In this scenario, you're looking to retire, and you don't have any, you have a small pension, so you have a state pension, and you've built out a property portfolio, and you've got £50,000, up to £50,000. You've bought property that pays you up to £50,000 a year in taxes. You're a 20% taxpayer, and you use those properties to pay you every month as kind of your living expenses. And then you have a limited company which has a director's loan account in it, and the limited company has other properties in it that could be paid to you later on via dividend at 7.5%, or in the most preferred option, you just have this £50,000 coming in from your 3 or 4 properties that you've got in your own name, and you don't need to withdraw any money from your personal limited company where the other properties are. Then in that situation, having a hybrid and diversified model would be good, because you wouldn't be adding to your tax bill, so you'd always be a 20% taxpayer with the properties in your own name, and therefore you're not going to be liable and get caught out by Section 24 taxes, because all of the money in the company is just accruing and building compound interest, while the other properties are giving you your income to live on. So that would be like a hypothetical example. Again, even in that situation though, if we add in other factors like inheritance tax and capital gains tax and all those other things, it might change the situation again. So this is why it really does depend on your personal situation. But hopefully what this presentation is doing is helping you, give you insights and information that you can use to consider about your situations and how it would be applicable to you. And the thought processes that I have learned and adopted over a number of years of doing myself and doing for a lot of my clients, and how that kind of manifests to become to the decision-making process and helps it easier. Now, last point again, if you want to build a property portfolio for intergenerational wealth and build some form of legacy, therefore income tax is an important part of your decision-making process and inheritance tax as well, then having properties owned in a company with an alphabet share structure or a smart company share structure is ultimately the best option, which is why I call it in my other video the perfect property tax strategy. So again, if you haven't watched that video after you finish watching this video in a minute, I would encourage you to head over and watch that video, and it will give you a real insight into smart company structures and how they can be beneficial for families in inheritance tax planning and mitigating inheritance tax. Now, to really summarize then, the biggest advantage in my personal opinion, regardless of income, when you are a low rate taxpayer, is that whenever you buy a property in a limited company, you can benefit from a director's loan account, which allows you to withdraw the net income from the properties without paying any tax up until the full amount of the director's loan. Now for me, that one benefit outweighs pretty much everything else, in my opinion. And again, I'm just going to reiterate this point, because if I were to buy property, 3 properties in my own name, assuming that we're just buying them from scratch, no losses to carry forward. I'm a low rate taxpayer, I've got £100,000 of savings. I buy 3 properties with £100,000 of savings. Everything in my personal name is liable to inheritance tax. It's above the tax threshold, number 1. Number 2, even if I'm not above the tax threshold for inheritance tax, at some point I may be. Number 3, the biggest thing is that even if I buy them as a lower rate taxpayer, assuming I don't have to pay any inheritance tax because I'm under the threshold, I'm still paying 20% tax on the property income, which I could defer for a number of years and create a tax saving strategy if I was to put the £100,000 into the business's director's loan account, because that can come out completely free of taxes. So let's say it was paying me $30,000 a year. The $30,000 a year at 20% is $6,000 a year in taxes. Whereas the $30,000 a year in a company is completely tax-free, independent of any other income, for let's say just over 3.5 years. 3 years and really a third. Okay, so 3.3 years. 3.33 years is the exact calculation. You're going to benefit from being able to draw out that £30,000 from the limited company into your own name, completely free of taxes, as opposed to buying them in your personal name, even if you're a low rate taxpayer. So for those sorts of points alone, I personally am always weighted towards a limited company. Maybe slightly biased, just my personal opinion. I've thought about this a lot and generalizing slightly, but if I had to choose one, I'd always buy in the limited company. The limited company also allows for future proofing. It's a great way, it's a great vehicle to allow for future growth. It protects you from capital gains tax if you use smart companies with freezer shares and stuff. It protects you from inheritance tax if you put a smart company structure attached to the limited company, and you can do lots of creative things, and you can withdraw tax effectively using multiple shareholders and their marginal rate of tax. So I have a lot more options in a limited company basically to save taxes than I do when buying property in my personal name. Now, I'll kind of like wrap up here. So I kind of touched upon it in these videos, but I'd really encourage you, if you enjoyed this video and you found it helpful, to go and really check out some other videos on my channel around the perfect property tax strategy, which is going to introduce you to smart company structures and family investment companies and the benefits around that and saving inheritance tax and all those sorts of things. And I would encourage you to check out other videos on my channel that talk about dividends, so withdrawing dividends from a company and how to do that in the most tax efficient way when you're paying yourselves the dividends from the company at 7.5% or 37.5%. There's another video on that, and there's multiple videos. There's multiple tax videos within my channel that talk about different variations of tax that would be applicable, and you could link to this video as well to help you have all of the information. Again, I didn't put all the information in one video because it's already long. It's already a lot to digest. The reason why I did this in a presentation format is because I think it's a really important subject, and personally, like I kind of geek out over property taxes. Like I'm a big fan of like, it doesn't matter how much money you make, it only important how much money you keep, and how the money you keep that you can multiply. Like, yeah, I just fascinate over property taxes. It's kind of an area of passion for me, because there's so much to it, and it's just such a specialist area. And I also like to keep as much of my hard-earned money as I can, as I'm sure you guys do as well. So listen, I'll wrap up the video. If you like this video, please give me a like. I'd really appreciate it. It helps us get more viewers. It helps us to achieve our goals as a company, and share my vision with as many people as I can, and help as many people as I can, and give people great information, which is free and easily accessible on my channel. With the hope that it has an impact on your life in a positive way. So yeah, give it a like. And if you haven't subscribed already, hit that subscribe button to be notified of new videos. I create lots of new content on a weekly basis. And yeah, leave me some comments, guys. Like give me some feedback in the comments. Like if you found it helpful, let me know. If you didn't find it helpful, let me know as well. Just give me your feedback so that we can keep improving and delivering and giving you videos that are impactful and give you the most value. And also let me know in the comments, guys. Let me know in the comments like what your personal situation is and what you did and why. Like, did you buy in a limited company? Have you got a diversified model as a hybrid, or are you purely buying properties in your own name? I would love to know. If you've got any questions as well, just hit them in the comment section, and I'll personally reply to them, or someone from my team will reply to your comments and your questions and help out there. So thanks for watching. You've been great. Keep up the good work in your life. And yeah, be resilient, be great. I believe in you, and see you next time.